Good morning. S&P 500 monthly chart. We're going to go back here to 1996 where that big rally started and all the day traders had moved into the market and wanted to be part of the market when we got up here to the 2000 bubble. It took us a couple of years to hit that bottom in 2002 on the monthly level of the S&P 500. We rallied, we rallied again just like we did in 1996 to that top. We had another 4 year expansion to the top of 2007 where the financial crisis came in, where we had called these tops and we were going to miserably go down, and we did. From 2008 financial crisis bottoms on a monthly level in the S&P, we have rallied up, but we do get these monthly pullbacks from these beginning. This is where the bulls started. It's pulled back in 2010, made the higher high in 2011. We called for a correction on a monthly level. We went down 1, 2, 3, 4, 5 months in a row in 2011. We got support. But look at here. And we've come back up and we made a 2012 high of last year. What I want to show the MMT and our Worldwide Trader Network is that when we started calendar 2012, we went up January, February, and March. When we started April, though, we started these pullbacks on a monthly level. And we pulled back nicely to test where the 2012 started. And we had called for about a 10% correction. What I am going to show people on the S&P 500, the same pattern in 13 of January, February. Now we're going to end up March, and we're up here at all-time highs. And we are due for a pullback in the S&P 500. We will be buyers on the dip because on a monthly level we are extremely overbought up here at the top. That's how far the bull has ran. Other times when you get overbought, markets were different then. However, there's going to be a pullback on a monthly level. We'll be looking at the fact that we start the calendar earnings in April. There'll be a light trading week coming up when we go into Easter, and the April earnings season will start. Unlike the January quarter starting out, we know that FedEx and Oracle is tied globally around the world. Both missed their earnings miserably. Both of them. And they're bellwethers. Oracle is. So is FedEx. And it tells us a lot of what's going on along here in the U.S., but most importantly is the worldwide earnings and how the currency offsets are going to take effect because we have a very strong dollar today. The monthly overbought process is that we're going to have at least on the first correction in the S&P should be about 5% to 10%. The amount of money that remains on the sideline will buy equities because of the FOMC. Who is that? Mr. Bernanke is being very accommodative to Wall Street. The monthly mortgage-backed securities that they're buying, that's going to come off of the table. A lot of our U.S. economic indicators are faring much better than worldwide countries like Germany or France. And let's take Asia. I didn't say Japan has been on fire, but when you get over to the Chinese markets, they're not rallying like the U.S. market. We are overbought on the S&P 500. And bull runs are going to have corrections. So we're telling people to be very mindful that there is going to be a reason to sell. There is a Cyprus problem over there. Europe is having their problems. The growth in Europe is in recessionary territory versus the U.S. Our markets have run parabolically up in this bull cycle. The earnings per share in the S&P 500 right now, I think they have them back up. They're looking at $110 per earnings per share in the S&P 500 companies. That's in the index. Having said that, there will be pullbacks that are coming, and that the bull has bought every single dip so far this calendar year. The S&P ended up at 1556.89 at 1109 gain on the S&P 500. We have been around for many, many years, and when you get to these overbought levels, you don't want to chase markets up here. Not only that, when I go back to the monthly level, we have, let's just blow up these tops. And here they are right here. This is a 2007 top. As I move this over, here was a 2000 top. I will go ahead and reconstruct the trend line. Let's do a horizontal line right across here. Let's go with the body, which was where we sold off in year 2000. When we tested that back in 2007, 2008, we went straight down. Now take a look at this monthly bar in the S&P. It's right up here. So the top end of that S&P potentially is 1576, but it's going to have a wall of resistance at 1567, which is 2 points higher than what we were over here, where we had the big correction. And it's a monthly topping parabolic month of taking that S&P straight up to the highs. However, in 2012, you can see where these big dips came into play right here, and then we rallied up off every bottom, and the bull kept going. A lot of people remain on the sideline. A lot of people will be returning to the equities. If you're a small day trader that was washed out of the market, visit us. We'll give you trading capital. I am telling everyone that the S&P 500, each time that we go up, it's going to be that much more overbought. It hasn't been this overbought since, let's take a look. It has not been this overbought since 4/1 of 1998, when it hit 95% overbought in that calendar month, which was April. And we're approaching April now at the end of the calendar month. So I am telling people to be very, don't chase the markets up here, wait for the dips. We're at 93.18%, and we could come right up here to 1576 if it can clear the 1567 area, which we've always told everyone about. That's going to be somewhere right around in here, 1569, let's say, a couple points up above it. So the higher that we go, the more overbought the bull is. There will be a move downward. The price volatility moving forward in the S&P 500 index will increase in both the reversal to the downside and to the upside. Each dip has been bought, and each rally has continued to go higher. There will be a pullback of 5-8%. We have to deal with the earnings per share and how the market will or will not discount it. And all the bulls that used to be bulls that are not in the market will be the first ones to buy the dips. We don't recommend trying to buy these things up here at the high and then hold them. You got to wait for those corrections. But once those corrections come into play, you definitely will want to own the S&P 500 unless something fundamentally was to really change in the U.S. Right now, we have enough data that the jobs data is getting better. The housing market's getting better. They've been selling more automobiles. Discretionary income with the consumer has been still, in my view, remains weak, as they always do. With the taxes going higher, we got lots of things that are involved here. So basically, what we're looking for is buy the dip mentality in the S&P 500 during the earnings season. We're extremely overbought. Forward looking, you are going to have a correction. Forward looking. If you own it up here at these highs or you're trying to chase it, not a good thing to be doing. You got to wait for pullbacks in the S&P. The wall of resistance is going to be right up here at the high at 1576. The 2007 reversal that went straight down in the Armageddon, and the world was ending down here when it was a great buying opportunity. This bull that started here from the lows have been in play now, and it's calendar 2013. And what I'm saying is, just like in 1996 up here, we had that 4-year expansion, gave it all back, had another 4-year expansion, gave it all back. Well, I can tell you, because of the multiple on the S&P, was at such high levels. It's taken well over 12 years to work that high multiple off and get the S&P adjusted to the right multiple to get higher. Please be careful if you're long these markets up at the top, because they're going to still have to deal with weakness as far as growth. And that there's a lot of contributing factors that would give this pullback. And of course, we think that the fourth quarter of the year is where we're going to really make the highs in the S&P, and that in the short term, just buy the dips, because the bull is real. And it's taken over 12 years to get out of this long-term secular bear into the bull run that we are experiencing now. So, once again, our analysis on the monthly S&P 500 is do not chase these highs, whatever you do. There will be a reversal coming. We've called every single one of them on time, just like we did in 2012 when they ran it straight up, and it was a buying opportunity. We had another dip down, and this particular bull run started back in November of calendar 2012, right here in this monthly bar. And then there was your December move, and then January, February, March. So this move has got 5 months already in the making to the high. Every bull will have to pull back. Be buying on the dips as long as the fundamentals do not change in this monthly earnings cycle that we're going to go in April and May. And the old saying is, buy in November and go away in May. Well, that's an old myth. This bull is very strong, but every bull will have a pullback. They all do. And this one will too. So there'll be money to be made on getting some VIX calls up and out of the money, the fear indicator, getting some S&P 500 index puts to hedge portfolios. All of that comes into play. And we're going to watch this major topping pattern that happened over here. And we're approaching it right here. We actually got it slightly above the trend line. There's that wick on that monthly reversal. That's the wall of resistance moving forward on the S&P 500. With calendar earnings starting in April, and extreme price volatility will hit the market.